You have a trading account with $3,000 in it. You made $180 last month. You tell a friend. He asks if you are rich yet. You laugh. You are not rich. You are not even close. But something happened last month that you do not fully understand yet. The $180 was not the point. The mechanism that produced it was the point. You just do not know that yet. You will. You are withdrawing your profits every month. It feels logical. You earned it. You take it. Your account stays at $3,000. Your monthly profit stays at $180 when the trades go well. You are running on a treadmill and calling it progress. The account never grows because you never let it grow. This is the first and most expensive mistake traders make, and almost nobody talks about it directly. You are treating your trading account like a paycheck instead of treating it like a compounding engine. Those are two completely different machines with two completely different destinations. You stop withdrawing. You leave the $180 inside the account. Month 2, your account is $3,180. You make the same percentage return. The dollar amount is slightly larger, $190 this time. You leave that in too. Month 3, $3,370. The number is not impressive yet. You are right to feel that, but something has changed structurally that your brain has not caught up to yet. You are no longer trading a fixed base. You are trading a growing base. Every profitable month is now working on a larger starting number than the month before it. The machine is on. You just cannot hear it yet. This is what compound interest actually means inside a trading account. It is not a savings account concept. It is not something your bank does passively while you sleep. In trading, it is an active structural decision. The decision to reinvest profits back into the account rather than extract them. That single decision, made consistently and without exception, is what separates traders whose accounts stay flat for years from traders whose accounts begin to accelerate in ways that feel almost mathematical, because it is mathematical. Entirely and precisely mathematical. The numbers need to be understood clearly, because most people hear compound interest and nod politely without actually running the calculation on their own situation. Take a $10,000 trading account. A trader generating 5% monthly returns and withdrawing every dollar of profit ends the year with $10,000. The same trader generating the same 5% monthly return and reinvesting every dollar ends the year with $17,959. Not $10,600, not $11,000, $17,959. Same trader, same system, same market, different decision about where the profits go. That gap widens every single year the decision is maintained. By year 3, the withdrawing trader still has $10,000. The reinvesting trader has $57,000. The math is not complicated. The discipline required to execute it is. Your account reaches $8,000 after 14 months of reinvesting. You have not added any new capital. You have not changed your strategy. You have not found a better indicator or a better entry technique. You have done exactly one thing differently. You left the money inside the machine. And the machine has been using every dollar you fed it to generate slightly more than it generated the month before. You are beginning to understand something that very few traders in your circle of contacts actually understand in practice, even though most of them could explain it theoretically on demand. Position sizing is where compounding becomes dangerous if you ignore it, and powerful if you manage it correctly. When your account grows through reinvested profits, your position sizes need to grow with it proportionally. Not because bigger positions are better, because your risk parameters are defined as a percentage of your total account. 1% risk on a $3,000 account is $30. 1% risk on an $8,000 account is $80. If you were still risking $30 per trade on an $8,000 account, you are under-deploying your capital and slowing your compounding rate unnecessarily. If you did not adjust your sizing upward as the account grew, you are not actually compounding. You are just saving inside a brokerage account with extra steps. The flip side of this is equally important and far more dangerous. If your account drops through a period of losses and you fail to reduce your position sizes proportionally, you are now risking a larger percentage of a smaller account than your rules allow. A 10% drawdown on a $10,000 account leaves you with $9,000. If you keep trading the same dollar size instead of scaling down, your next 10% loss hits a smaller base and takes you to $8,100 instead of $8,100. The math compounds in both directions. Compounding works for you when you win consistently and it works against you when you lose without adjusting. The discipline of scaling both up and down is the unglamorous detail that separates traders who compound successfully from traders who experience occasional large wins followed by account-erasing drawdowns. Drawdowns deserve their own examination because they sit at the center of every compounding conversation that is being had honestly. A 20% drawdown does not require a 20% gain to recover. It requires a 25% gain. A 50% drawdown requires a 100% gain to return to the previous peak. This asymmetry is the reason that protecting your compounding base during losing periods is more important than maximizing your compounding rate during winning periods. The traders who compound most effectively over long time horizons are not the ones with the highest monthly return figures. They are the ones with the most consistent return figures and the smallest maximum drawdowns. Consistency and protection of the base matter more than peak performance in any single month. Your account crosses $20,000. You did not deposit additional capital to get here. You grew it from $3,000 through consistent reinvestment of profits over roughly 2.5 years of disciplined trading. The account has done something specific at this threshold that your earlier account never did. It has begun generating dollar amounts per trade that feel significant in absolute terms, even though the percentage risk per trade has not changed. 1% of $20,000 is $200. A 3-to-1 reward to risk trade at that size returns $600. A few of those trades in a month, and the monthly profit figure starts to look like what most people would call a real income. The compounding is becoming audible now. You can hear the machine. Most traders never reach this point because they extracted the profits that would have built the base required to generate these dollar returns. They spent the $180 months and the $240 months and the $310 months on things that gave them immediate satisfaction and zero compounding value. They converted potential future capital into present consumption and then wondered why their accounts never grew past a certain size, no matter how well they traded. The discipline of deferred gratification inside a trading account is not a personality trait you either have or do not have. It is a decision you make every single month when the profits are sitting there and your spending mind is constructing reasons why this particular month is an exception. There are no exceptions. That is the entire point. The compounding works precisely because it is uninterrupted. One large withdrawal at month 18 does not just remove the capital you withdrew. It removes every future dollar that capital would have compounded into over the remaining years of your trading career. You are not just spending the profit. You are spending every descendant of that profit across every future month. This is the calculation most traders never run. When you run it, the decision to leave the profits inside the account becomes significantly easier to maintain. Taxes are real, and they require honest planning inside any compounding strategy. In most jurisdictions, trading profits are taxable in the year they are realized. You cannot compound pre-tax profits indefinitely inside a standard brokerage account the way you can inside a tax-advantaged retirement account. What you can do is plan your withdrawals specifically for tax obligations rather than lifestyle spending, keep a separate reserve for your tax liability outside the trading account, and structure your trading entity in a way that optimizes the tax treatment of your profits. The traders who compound most efficiently are not just disciplined about reinvestment. They are disciplined about structuring the reinvestment in the most tax-efficient way available to them within the legal frameworks of their jurisdiction. Your account is at $47,000 now. You have been trading for 4 years. You added capital twice, $2,000 each time during periods when you had excess savings, and the account was positioned well for deployment. The rest of the growth came from reinvested profits and the compounding of those profits on an expanding base. Something has shifted in how you relate to the account that is difficult to describe precisely, but is real and significant. You no longer think of the account as money you are trying to make more money with. You think of it as a compounding engine that you are responsible for operating correctly. The difference is subtle, but it changes every decision you make about the account. The way you think about losing trades has changed completely. A loss is not money gone. It is the cost of operating the engine for that particular trade. Every machine has operating costs. The question is whether the operating costs are within the parameters that allow the machine to remain profitable over time. A loss within your defined risk parameters is not a failure. It is the engine running exactly as designed. A loss that exceeds your risk parameters because you sized incorrectly or held past your stop is a maintenance failure, not a market failure. Your failure. And maintenance failures are the only category of loss that genuinely threatens the compounding trajectory because they introduce randomness and size into the loss column that your system did not account for. At $47,000, you start thinking about a second account, not because you need one, because the compounding math on a second smaller account started simultaneously 4 years ago would have produced a second growing base by now. You open a second account with $5,000. You treat it as a separate engine, running a different strategy in a different market. The diversification is not about reducing risk in the traditional portfolio sense. It is about not having all your compounding concentrated in a single strategy that could face a structural edge degradation if market conditions change. Engines can be maintained and replaced. A single engine that fails stops everything. 2 engines running different strategies and different instruments means the compounding continues even if one engine requires adjustment. The concept of edge degradation needs to be understood by every trader building a compounding strategy. A trading edge is not permanent. Markets evolve. Participant behavior changes. Regulatory environments shift. Algorithmic trading adapts to patterns that become widely known and exploited. An edge that generated 5% monthly, returns consistently for 2 years, may generate 3% in year 3 and 1.5% in year 4 as the market structure that created the edge adjusts. Traders who are compounding on the assumption that their current edge is permanent are building on a foundation that may shift beneath them. The intelligent approach is to track your edge metrics continuously and begin developing the next edge before the current one has fully degraded. The account reaches $90,000. The compounding rate has slowed slightly from the early years because you have become more conservative with position sizing as the absolute dollar amounts have grown. A 1% loss on $90,000 is $900. The emotional weight of individual losses at this size is different from the emotional weight of $30 losses on your original $3,000 account. You adjusted your risk percentage slightly downward during the scaling process, not because the system required it, but because your psychology required it. This is an honest and legitimate adjustment. A compounding strategy that you cannot psychologically maintain is not a strategy. It is a plan that will be abandoned the first time the losses feel real enough to override the discipline. You tell a newer trader what you did, not the return percentages, not the account size, the one decision. Leave the profits inside the account. Reinvest every dollar until the base is large enough that the dollar returns are meaningful without taking them out. He listens. He nods. He tells you he needs the profits now because his expenses are high. You understand. You had the same expenses. You made the same argument to yourself for the first 6 months before you stopped making it. The argument feels logical. It is not a logic problem. It is a priorities problem dressed in the language of necessity. Somewhere right now, a trader is looking at $180 in monthly profit and thinking it is not enough to matter. He is right that $180 does not matter. He is completely wrong about why. It does not matter because of what it is today. It matters entirely because of what it becomes if he leaves it inside the machine and lets the machine run without interference for long enough that the compounding has room to show him what it actually is. The $180 is not the point. The mechanism is the point. It was always the mechanism. But he will figure that out. The ones who stay long enough always do.